If you want to better understand how the Federal Reserve's decisions impact your investments, make sure you subscribe and stick around, because today we're going to break down exactly how interest rates affect the stock market. So let's start with the basics. Whenever the Fed raises interest rates, it makes borrowing more expensive. That means companies have to pay more to finance projects, take on new loans, or service their existing debt. And when those borrowing costs rise, profits shrink, which often puts downward pressure on stock prices. On the flip side, when the Fed cuts rates, borrowing gets cheaper, companies can expand more easily, and profits have a better chance to grow. That's usually good news for stocks. Now, there's also the way rates affect valuations. Stocks are priced based on the present value of their future earnings. The higher the interest rate, the higher the discount rate used in those calculations, and that lowers today's value of those future profits. That's why growth stocks, especially in tech, tend to get hit harder when rates rise. But when rates are low, those same future profits look more valuable, which lifts valuations. Rates also shape investor behavior. When interest rates climb, bonds and savings accounts suddenly look more appealing because they're offering higher, safer returns. Investors often rotate money out of stocks and into those safer assets. When rates are cut, the opposite happens. Safer investments yield less, so people are pushed back into the stock market to chase higher returns. Different sectors feel the changes differently. Banks and insurers often benefit from higher rates because lending margins improve, even though demand for loans can slow down. Utilities and real estate tend to struggle when rates are high since they carry large amounts of debt and investors see them as alternatives to bonds. And growth-focused sectors like technology usually feel the biggest squeeze because they depend so much on long-term earnings. Rates also affect consumers directly. Higher mortgage rates, higher credit card rates, and higher auto loan rates mean households have less money to spend elsewhere. That reduced spending trickles down into corporate revenues, which again puts pressure on stock prices. When rates are low, consumers tend to spend more freely, which supports company earnings and stock performance. It's important to remember that the Fed's decisions are about more than just numbers. They also send a message. A rate hike often signals confidence in the economy, but also concern about inflation. A rate cut can signal support for growth, but also raise worries about a possible slowdown. In fact, sometimes the market reacts more to the Fed's commentary than the actual rate change, because investors are always trying to predict what's next. And finally, we can't ignore the global angle. When the United States rates go up, the dollar tends to strengthen as investors from around the world chase higher yields. That stronger dollar hurts United States companies that earn money overseas because their foreign revenues translate into fewer dollars back home. It can also weigh on commodities like oil and gold, which are priced in dollars. So to sum it all up, higher rates usually mean more pressure on stocks, while lower rates generally support stock prices. But the story is never that simple, because every sector reacts differently and expectations often matter just as much as the actual decision. If you found this breakdown helpful and you want more insights into how economic policy shapes the markets, hit that subscribe button and share this with someone who's curious about investing. That way you never miss the bigger picture.